as I'm not an international property investor, unfortunately, I don't know whether I'm qualified to say. What I could comment on is I think that the UK government has made it increasingly more challenging for landlords to do things and make a profit because of the tax implications of their policies.
How do you deal with tenant disputes or tenants with such character?
Well, I think you've touched on some really important things there about practical ways of developing essentially relationships, and relationships are so important in property and letting, and there is a sense of feeling that you get, isn't there, when you meet people, whether it's the neighbours or whether it's the tenants themselves. And then I realised actually no, the neighbours can actually be your best friend. They can be people that if the property is vacant, they will tell you if there's an issue. If they do have issues with a tenant.
But in properties, in your opinion, do you think it's feasible or practical to time the market to say, I think there's a crash coming, I'm going to hold on for the next 2 years, then I'll buy a property?
That is not something I would do, most definitely not. But there are people who do that, but it's more speculative, isn't it? There's a bit of luck involved, in my opinion. I believe you can use data to inform your decisions, but it needs to be over a much longer period, is my personal view.
Ross, thank you so much for joining us today.
You're welcome. Pleased to be here.
You definitely have a very interesting background in economics and have done very well for yourself in property. But I would like to get into deeper why you chose property and what your journey was like.
Sure. So, as you say, I studied economics when I was in my 20s. I was lucky enough to be taught economics by a very prestigious individual, actually, Peter Sinclair. He actually taught David Cameron economics, although maybe some would say that was something that I shouldn't perhaps boast about. But when you've studied economics, it inspires you really to want to be successful. It makes you want to take risks. And I think naturally my innate qualities are not to take risks. But by having some exposure and understanding to the world of finance, it has enabled me to perhaps invest more wisely than I would have done if I hadn't studied economics. So that's a little bit why I decided to invest in property. It's relatively small time, and essentially I put my money into a special purpose vehicle from a pension.
It's very interesting you say that your character is as such that you don't want to take high risks. But getting into property itself, it can have significant risks. Like I know people, like last week we had a conversation with a solicitor who said one of the landlords was imprisoned for 5 years for unlawful eviction. That's a big risk. Yes. Another person on a bridge bought a property, could not refinance after he defaulted, banks took over. That's a risk. So how did your perhaps background in economics, did you get to have, did that give you any maybe fundamental principles that helped you in your decision making?
Oh, most definitely. I've always been someone who thinks you need to do due diligence. So making sure when you invest in any investment, you've got to make sure you do that lawfully. You've got to make sure that you're managing the risk. And now my line of work is data, so all of my decisions are data informed. So I make sure that I do cost benefit analysis of every investment. And one of the big principles that I follow is what's the return on investment going to be. I also, if you have considered other investments such as the stock market, make sure that my investments are going to be for the long term. So when you invest for the long term, I'm talking about 10 years, 20 years plus, you have some fluctuations obviously in price over that time, but you can ride out those fluctuations because we know over the long term, property goes up in value. That's what the data tells us.
But before I get too much into property cycles, which I think will be very interesting to discuss,
sure,
I'm curious to know what it took the young Ross from his degree in economics to buying his first property. What was the process like? Why did you go for property?
Well, I think to start off with, I was what most people I think call a accidental landlord. So I purchased a property in my early 20s, fortunate enough to do that. It was back in 2009, so there'd been a property crash. I actually bought just before the property crash, so that wasn't purchased as an investment. That was purchased as a home. So I lived there. I had some inkling, maybe I should be going into property, because before this crash, we saw prices increasing exponentially. And I'd only been on the planet for 20 years, so I thought, this is what happens to property. Surely you want to invest in this. But then we saw the crash, and that can then make people nervous about investing. So I held off for some time, and I met my wife. We moved in together, and then I've got this additional property there that I've not sold. So that's when I decided to start letting it. And as you alluded to earlier, you can, if you don't do things right, find yourself in difficult situations. I didn't find myself in too much of a difficult situation. I just found that I didn't do things as professionally as I do now, and ended up with tenants that I perhaps wouldn't select now, and had a property returned to me that was in a state that wouldn't be acceptable now, and I hadn't done the due diligence to say, make sure this is all outlined in the contract, and I'm going to get the photos before the tenants move in to say, this is going to be deducted from your deposit. So it kind of, that situation wiped its face, and we eventually sold that property. Some years on, then we think, well, actually property could be a good investment for supplementing our pension. We both work full time, we're high income earners. We knew we were going to have a good pension anyway, because we work in the public sector, but we wanted to do something extra so that we can retire early. And that's where property obviously was a good opportunity. I had some experience of it. As anyone who invests in property learns, experience is often hard earned, and you learn by your mistakes quite often, and hopefully the people listening to your podcast won't make the same mistakes you and I have, because we share those experiences, and they will think, well, if I'm going to get into even just a small time rent, I'm going to make sure that I do things as I should. So we then started acquiring properties, and before we did acquire our first property, and I started thinking about what's the best way to do that. Is it to buy property in our own name, or is it to buy it through a limited company? And we went with the limited company option, primarily because of the tax reasons around that, because the government is making it increasingly more challenging to invest in property. So that's kind of how we started, really. And then I set up Bailey Real Estate and purchased the first property.
That's interesting. I also want to cover this in more detail, perhaps how investors can protect themselves, because in today's generation, everyone wants to sue each other. So how can you protect yourself? But you said when you guys are high income earners and you wanted some supplementary income, you've got a lot of companies out there on the stock market. I believe even Persimmon Homes, they're one of the largest developers in the country. Here for centuries, I think, and they give 10% yields on the stock market. So you've got multiple different streams that you can get that supplementary income from. Why was it property? Why not stocks, or maybe just rely on gold, perhaps, on capital appreciation from that? Why property?
Okay, so as we mentioned earlier, there are lots of different theories in economics about land ownership, aren't there? And we could sit here and have probably quite a boring conversation about those theories. But there's one thing that is quite basic and still holds true, and that's simple supply and demand. So when you look at the property market in the United Kingdom, we see that there's not enough properties. As simple as that. And yet the demand is increasing. We have an increasing population, and people always need somewhere to live. So as an investment opportunity, land and property, they're intrinsically linked, and it's always going to be so in terms of property, we were talking about supply and demand.
Yeah.
So the supply of properties in this country is not meeting the demand, is it? So we know that it's always going to be a situation where there's a pressure on price increases, and if price increases are not happening, we've also got potential rent return. So when it comes to property, you've got that aspect of that investment type, but we've also got something which we know exists, which is leverage. So maybe if you haven't got as much money to invest in into something, property is something which gives you leverage. So I could explain the concept of leverage a bit more. Say if you've got £50,000 to invest, a small sum to start a property investment portfolio, but it's something which could be has a lot of potential over time. If you took that £50,000 and invested it in gold, as you suggested, you could, over a 10-year period, maybe see that investment increase, let's just say, hypothetically, by 50%. That means in 10 years' time, your £50,000 has become £75,000. Yep. All things being equal. If you took that same £50,000 and invested it in one property, that property might be worth £200,000. But you've only put £50,000 into that investment, 25%, which most buy-to-let mortgage brokers will still offer you as a deal. Over that same 10-year period, we're going to say that same investment increased by the same amount, 50%. But we're now seeing £200,000 become £300,000. So your initial investment of £50,000 has given you a return of
200%.
200%, £100,000. So we're saying all things being equal again here. We've got to make sure that over the journey of that investment, your mortgage repayments have been covered by your rental income and any maintenance that you've had. But there in itself gives you an example of how an amount of money can work harder for you in property than in another investment. I need to caveat that with, obviously, prices go up as well as down, and you could also be exposing yourself to greater loss. But if we go back to our original theory, which is we're investing over the long term, we would hopefully see that we can ride out any price increases and decreases over time.
This is probably by far the most important or the best reason why I love property. Mm-hmm. If I've got 500,000 in the bank, I don't see it as 500,000. I see it as £2 million. What £2 million can it buy me, you know? So that's by far the best reason property is there for me. And of course, the rental income as well and the capital appreciation. But you mentioned something very interesting about supply and demand. UK has this massive shortage of housing. I think the UK's government's target is to build 300,000 homes a year. And from what I've read over the last decade, they've not even been meeting half of that target every year. So in a way, do you think being an investor in UK kind of spoils you in comparison to if somebody was to invest in America? Because here in the UK with this shortage of housing, anything you have will let. As long as it's got working electric and plumbing and a bit of insulation and it doesn't have too much, it will let. But perhaps in places where there isn't massive shortage of housing, like Dubai, I think they're constructing a lot. Do you think being in the UK has this advantage that being in the other countries don't have?
Ooh, it's a difficult one, really, as I'm not an international property investor, unfortunately. I don't know whether I'm qualified to say. What I could comment on is I think that the UK government has made it increasingly more challenging for landlords to do things well and make a profit because of the tax implications of their policies. That's why, as an individual, I decided to invest in property through a limited company, special purchase vehicle. We've only got a small number of properties, but we still felt that it was necessary to buy those through a limited company so that we could offset the mortgage interest rates as a tax deduction and therefore make some profit from the rental income. But rental income isn't really my strategy in the short term. In the short term, it's more about capital growth for me. And I think that is an important thing, really. might be deviating from your question slightly, but in terms of our strategies as property investment people, you've got to be looking at why are you going into property? Because you might be going into property quite young in life. And if you are, I would suggest that it's about capital growth, increasing your portfolio. But as you mature in your years, you might want to shift your property portfolio so it's less about capital growth and more about income return, because that's when it's going to actually be funding your day-to-day living. Unless you're in property full time, you're going to potentially be using it as an investment opportunity for the future, and it's about refinancing, acquiring more properties, and building wealth, essentially.
Earlier on, you also mentioned about property cycles. There are some downturns in property, like they normally do. There are cycles. Could you shed a bit more light onto that? You mentioned about 18-year cycles or whatsoever.
Yeah, there are a number of people that believe in something called the 18-year property cycle. I was a bit of a believer in that. Recently, you could potentially say this theory is dead, because we've seen that we should perhaps be in an explosive growth phase now if you believed in that 18-year property cycle. And what we're seeing now is we're not. If anything, we're seeing a bit of a soft landing, really, with property prices reducing now. But there is a principle that people believe that over an 18-year period, we see this cycle of a recovery phase following a recession, and that recovery phase usually lasts for around a 7-year period where we see a slight growth in property, and then the data suggests there's a little dip in property prices around that 7-year period, and then that's followed by an explosive increase in property prices, and that too lasts for another 7 years, at which time we then see a recession phase where property prices reduce dramatically, and then the cycle begins again. And what we see is over those 18 years, the data has suggested that the prices follow this very similar trend, and it can go back 300 years and see this data existing. And as investors, particularly if you're in it as a full-time job, you knowing this information can make your decisions in a more informed way, because you're thinking, right, we're at this stage within the property cycle, and therefore I'm going to either double down on my investments or I'm going to hold my nerve, because I know that this is what's happening historically. And what we often see in the media, the headlines that tell us, this is happening, quite often isn't the case. And this is what drives the majority of the population to make their decisions. But when you're using data to inform your decisions, you can think to yourself, well, actually, I can see what's actually happening. So in terms of cycles, I think most people would expect us to be in this rapid growth stage now, if you were a believer in the 18-year property cycle. But what we're actually seeing is a bit of a crash, really, but it's a soft crash. When you look at the media, the mainstream media, they're not talking about huge reductions in house prices at the moment, are they? They're quite small reductions in house prices. But then you factor in inflation, and we all hear the news stories about inflation at the moment, and factor that in, house prices actually have reduced quite significantly in real terms. So that is an argument to say maybe this 18-year property cycle doesn't bear true. But I go back to my original point. We've got to look at this as a long-term investment of 10, 20 years' time. And if you're holding that asset, I'm not going to guarantee anything because, people do sue people. But what we should hopefully see over the long term is that house prices will still be increasing, and property will still be an asset that, if people have invested in, will be comparable with the returns that other investments offer as well.
I love what you've said. I'm a fundamental believer in cycles. I love studying this guy's work, Ray Dalio. Not sure if you've heard of him. He manages a fund, a hedge fund in America. I can't remember the name of it. Bridgewater, something like that. And it's got hundreds of billions of dollars worth assets that he controls. And he himself is super wealthy, like 18 billion or 20 billion, something like that. But his journey to where he is now is so important. Like, I've read all his books. I think he must have written 4 or 5 books. This guy is super knowledgeable. What he says is somewhere in the 1970s, I think 1972, when he was starting off in his career, there was an incident. I'm not sure whether it was when President Nixon decided to say that gold is no longer pegged, the US dollar is no longer pegged to the gold. I'm not sure whether it was that incident or somewhere else, but he was predicting that the market was going to collapse based on his indicators. But what happened was the exact opposite. And he had gotten all his investors to back him up to say the market is going to collapse, it's going to dip. But in fact, the opposite happened. And he lost everything he had. He lost his reputation, which is the most important, his clients, his staff. He didn't have any money. He lost everything. So he was back to square one. But he went into this phase reflecting that, what happened? Where did I go wrong? Like, these are my indicators. People use these indicators. It clearly reflected that the market's going to drop. What happened? It came to his realization that there are cycles. And they're not 10-year cycles, 18. There are 10-year cycles, 18-year cycles, but not just that. There are some cycles that happen once in a lifetime. Cycles that last 100 years, 150 years, 200 years. Like, for example, the global pandemic now, COVID. People get shocked. But it's not the first global pandemic. I think you had Spanish flu, where millions of people died. It was global, but it didn't happen in our lifetime. So he went into studying history, 500 years worth of data, to study what made dynasties, what made them collapse, the printing of money, devaluation of currency. It's not the first time it's happening. It's been happening since the first time currency was created, innovated. Those coins, the gold coins and silver, they used to devalue that by cutting out the edges of the gold or copper. So they had their means. So he went into studying all of that and put that into his decision making, factoring all of that, 500 years worth of data, and it's made him super successful. So coming back to the current situation that we're in now in property and where we think we are in the cycle, what amazes me is the statistics say that over the last 20 years, the governments have had to print over $186 trillion as stimulus to grow the economy by 46 trillion. So it kind of tells me that if the printing was not done, then what would we have been in a negative growth rate? So it sounds like it's a bit of a Ponzi scheme there with how it's working. And with all of us investing so much in property, especially with leverage, how does one protect himself in the event if we are in a big bubble, which is about to burst with all this printing that's happened over the last since 2008 crash especially? What if we are in a bubble, and what if that's going to crash massively? Is there anything you think we can do, or you are thinking to do, to protect yourself from an event like that?
Well, we're seeing lots of different behaviours in the market, aren't we? With lots of landlords are now leaving the market. So one way is to obviously reduce your exposure and have less investment in property. You may not want to entirely move away from holding assets, though. I mean, I'm a great believer in assets giving you wealth, and what you do see over the course of the last few years is the value of assets are always retained. I mean, it's no coincidence that the way that the economy is structured, that these events often affect, unfortunately, the poorer in society than they do the most wealthy. So as a general principle, I would be very reluctant to sell off assets, and I would, where possible, retain as much property as I could, but I might review my portfolio and have a look to see what are good investments and what are more risky investments. But there are properties that over the long term will increase in capital value, and they're in good areas. We're seeing huge returns in the north of England still, in Liverpool, and in the West Midlands as well. And although what I mentioned earlier about prices reducing, what we're also seeing that being accompanied with is rent increases. So I'm not convinced actually that we are at a huge risk of losing lots of money. Maybe on paper, the value of these assets might be reducing, but if our rental incomes are covering our debts and we can hold over the long term, we will see prices return to the direction we want to see them. Other options, obviously, are to invest in different assets, maybe selling off your property and buying other investments through the stock market. Gold we mentioned as well. They often very similar, actually, if you look at the returns on houses and gold, but you haven't got that leverage effect. So those are options as well. Diversification, I suppose, is what you would be referring to.
You're right. I suppose people can do that. They can reduce the level of borrowing they have to protect themselves against an incident like that. But from what it seems to me, from my research, the only way governments or the economists can recover from all the printing they've done, four solutions really. One, either they can cut down on spending, but that really hurts the people. If the governments cut down on spending, it hurts the citizens. Two, they can just default, which again hurts the people. Three, they can print more money, which is that's what they're doing. Or the fourth is the transfer of wealth from the rich, from the haves to the have-nots by taxes, which they somewhat are doing. So some people try to use that information to tell where we are in the market, to try time the market. But I suppose people who are trying to do that are more in the stocks market. But when I study rich people, successful people, they say don't time the market, have fundamental values like what you just said, invest for the long term, maybe mitigate some risks, see what you can, look at your worst case scenario if you were to make an investment. And if that doesn't work for you, avoid it. Don't look at the best case scenario only. So they have some fundamental values like that. But in properties, in your opinion, do you think it's feasible or practical to time the market to say, I think there's a crash coming, I'm going to hold on for the next 2 years, then I'll buy a property?
That is not something I would do, most definitely not. But there are people who do that, but it's more speculative, isn't it? There's a bit of luck involved, in my opinion. I believe you can use data to inform your decisions, but it needs to be over a much longer period, is my personal view. It's like anything. It's almost like, you gamble enough times, then everything, if you gamble in a consistent and logical way, it will play out over the long term. And then as many times as you win, you will lose. And the net effect is that you will have a very similar return over the long term if you just took a very long-term view. And I'm very much of the opinion of maximum return, minimum effort, because that's my nature.
Does it work?
I think it does, because I'm not looking for huge gains. I'm not that risky relative to yourself. I think you'll be more inclined to try to take speculative purchases if you're more risky, and you can get high returns on that. But the risk is that you can also get losses as well. It'll be interesting to see over the long term if you took a more strategic view and say, I'm going to be fairly safe, see what happens over the long term, compared to someone who gambles a little bit more. As many winners, there will be losers, in my opinion. So that's why I take a very safe view, I think.
I suppose that's true. For me personally, when I'm looking at an investment opportunity, I look at worst case scenario, realistic practical view, what I think is realistic, and best case scenario. If I'm happy with the best case scenario, I'm happy with the practical view, and I can live with the worst case scenario, I'll go for it. I'll give you an example. We found a piece of land, contaminated land. It was used as a waste disposal site. So I agreed a purchase price with the person to a place where it works for me, works for them. It was mutual benefit because they needed out. They couldn't build it. There was too much cost to fix the site, but they already bought it without doing the searches, unfortunately. So we agreed on it, but I said, I'll buy it subject to two conditions. First one, I need to know how much soil needs to be disposed. Because if the council comes back saying that's 20,000 square foot of land, 3 meters deep, that's 60,000 cubic meters of soil to be disposed. Each wagon costs like 400 pounds of to dispose soil. That's going to cost me like hundreds of grand, like 150, 200 grand, easy. So it depends on what the response is like. Maybe they might just say, you need to dispose the soil in softscaping area. And that might just be about 1,000 square feet. I can live with that. So I'll do this condition 1. Condition 2, how deep is the bedrock? So in normally waste sites like this, normally they have made up ground. So in this one, apparently the first 5 meters is already made up ground. So they already need to pile. It's not going to be a normal foundation. So how deep do I need to pile? So I need to drill boreholes to find where the bedrock is. So I need to do these 2 investigations, which will take me 3 to 6 months. And if the responses that come back are favorable to me, I'll move on to completion. If they're not favorable to me, I'll walk away. I'll give you the reports. The reports are going to cost me 15 grand anyway. I'll give them on to you. It might help you.
With it being within a micro sector of the economy, I know the areas in Birmingham that very well because I've grown up here. So you'll appreciate that there can be in Birmingham streets that are very close to each other, almost on opposite sides of a main road, where one area will not increase in value over time, even for the 20-year period. And over the other side of the street, it's a good investment. We see perhaps areas of Birmingham around the Cawthorpe estate and over the other side of the road where there's some opportunities there, but it's going to be many years until those become high increases in value. So understanding your local area, I think, is one possible way of doing that. And that's like walking the streets and knowing those areas, what's desirable for people to rent and to purchase.
Out of curiosity, what's your appetite? What sort of return on investment do you look for?
Over a 5-year period, I'm only looking at like properties increasing by, I think, 20%. That's very realistic.
What about the rental income side of it?
For me, I just want it to wipe its face. So I'm not really that bothered whether I make huge amounts of money from rental income or not, as long as the long term, the capital's increased. Okay.
And have you been seeing that in your properties that you've been acquiring this far?
Yeah, most definitely. I mean, we've held properties in Selly Oak area. They've been purchased, I think, 5 years ago and have increased by 50%.
So it definitely seems like whatever philosophies you have that help you pick the right properties, it works. So is there anything in specific perhaps that you look at, like you just mentioned, a street? Is it just with your own knowledge about locations that you try to pick out the right properties? Is that all? Or is there anything further to that you check normally?
I'd have to think on this one, I think.
Because some people use platforms like Street Check, for example. They look at that. I think there are a lot of platforms out there as well that give you a lot of data about how much property prices have been selling for in the last 10, 20 years. So they try to look at the trend. Is there anything like that you look at perhaps?
Yeah, some of the purchases, I did go into that level of detail. You can get a little bit drawn into that, can't you, when you've got a bit of a data mind. I think that is quite useful. There is a feel as well, isn't there, to certain streets that I think no matter how much you've crunched the numbers, when you go to view a property, you get a sense of what the local neighbourhoods are like. And that's where I'm saying about that local knowledge is being really important, really. And it backs up that data. So when you look at things like crime statistics and local schools in the area, and if they've got outstanding schools, that's what attracts the young families. That's the things that they are looking for. Access to parks, recreational amenities, things like that. These are things that attract young families. Investments in the city, that's going to be your young professionals, isn't it, really? And you're looking for, I suppose, when you're investing in the city, these pockets of developmental areas where you're thinking, well, this is going to become part of the hustle and bustle in a few years' time. It might be quite quiet now, but that's what you're kind of essentially looking for, isn't it, really?
I think what you mentioned there is so crucial. That it's not just the numbers behind the scenes. It's also what you feel about the property, the feel you get about it. So I personally have a different approach, perhaps, that I'm always trying to expand my reach. So initially when I started off, it was a 5-mile radius from where I live. I was trying to just look there and expand further way on. Now at this moment in time, I'm trying to have more acquisitions of properties than I'm actually being sourced. So for that, I need to expand my reach. So Liverpool, for example, we've done a project there. And for me, it was a new area. So obviously I checked Street Check, Rightmove and Zoopla and Spare Room just to get a bit of insight about it. But then to get a feel about it, what I try to do is that I want to be in that neighborhood in the morning to see what the vibe is like. I want to be there in the afternoon to see what the vibe is like. And I want to be there at night to see what the vibe is like, because little you know, you buy a property that's good, the environment looks good in the morning and afternoon, but at night people are selling drugs there, or you get some other weird things happening there. So I want to make sure that's there. And I also like to speak to neighbors. Like one of the properties we acquired, new area, didn't know anything about it. Spoke to so many neighbors around. Anyone I could see there, knock on their door and just be like, sorry, can I bother you for a second? I'm new to the area. I'm just kind of curious to see, what kind of people live around here. What do you do for a living? And, just kind of get into a conversation with them, see what kind of work do they do? Are they on benefits? Are they homeowners? Are they tenants themselves? Just to get a vibe, how much rent they pay if they are tenants. So I try to get that kind of feel. So you are right. It's very important to get a feel, because one street can be so good and have untapped potential where it can have like 50% in 5 years, and the other one, not much. So you deal with tenants directly. And I've felt that there's some tenants that can be reasonable, and it would be good to have a friendly approach with them, because they're understanding, they're mature, they're responsible, they understand their obligations, and you understand yours from a landlord's perspective. But there's some who are only in the mindset of taking advantage of the system or whatever rights they have, which is sometimes unfair on the landlord. How do you deal with tenant disputes or tenants with such character?
Well, I think you've touched on some really important things there about practical ways of developing essentially relationships. And relationships are so important in property and letting. And there is a sense of feeling that you get, isn't there, when you meet people, whether it's the neighbours or whether it's the tenants themselves. And I think in the early days, I was a little bit of opposed to actually meeting the neighbours. I thought, if I meet the neighbours, that means that I'm going to get neighbours pestering me to say, what tenants are you putting in there? And is that going to be a problem for them? And then I realised, actually, no, the neighbours can actually be your best friend. They can be people that if the property is vacant, they will tell you if there's an issue. If they do have issues with a tenant, then I think you've got to address that. You have got to address that. There's no point burying your head in the sand. But the point is, don't get the problem tenant in the first place. So I think it's really important when you're looking for tenants to make sure that they're clear that you want a friendly relationship, but you also do things by the book. So when you set up your tenancy agreements, you've got to make sure you've got that very clearly outlined. You're making sure that your rent increases have been stipulated in your contract. It means that when you have that conversation 12 months time, they're expecting that conversation. It's not coming out of the blue. It's documented as well, as that you need these things in your tenancy agreement in order to be able to initiate them. Otherwise, you're then having to come into a conversation about, we're proposing a rent increase. Is that acceptable to you? Then you've got to issue the proper section if you come out of a tenancy agreement and it becomes contractual. I avoid all of that by making sure this is all upfront, making sure people that are renting the property understand what's in that tenancy agreement. They don't just see it as something I've just got to sign to get in. You're talking them through it at the point that you're letting the property to them. I'm not expecting you to decorate this property. You might want to decorate it. If you do decorate it, you've got to ask permission first. These are things that you might expect people to just inherently understand and know. But there have been occasions in my lifetime where I've gone back to a property and they've decorated the property without permission, and they think that that's a good thing. But when you haven't got the same taste as that individual, and then you say, no, you need to take this wallpaper down, you've got to paint it back to Dulux white. They're taking offense by that.
Yeah.
And this all becomes because of miscommunications, not developing a good relationship from the start. So I think the relationships part is important. Being friendly, being approachable as a landlord, developing that, but also doing things by the book, making sure that it's at the very start of the whole process, going through your credit and reference checks, making sure you've done that. I personally do that myself. I get a third party to do that as well, so I'll have a credit agency do reference checks, but there's nothing stopping you as an individual, if you're doing the letting yourself, asking them to fill in a free credit score and referencing themselves. So I use a particular one, I don't know if we can mention it, but Credit Karma, and ask them to fill that in and then send me that PDF document of their credit report. I can then see, before I've even sent it to a third party credit referencing service, what the score is, whether their address is what they say it is, whether they've had any CCJs or got any bad credit history. And it just helps you screen your tenants before you've even let the property to them. So I put a lot of upfront work into who I'm letting to, and over the years I've found since the first experience when I was an accidental landlord that it's only ever been a professional yet friendly relationship since then.
I think that's very smart that you dedicate a lot of time and effort in the beginning and do everything up front, because that avoids a lot of the confrontation later on. Have you ever had a tenant, say maybe in the previous times when you were starting on, who was very difficult to deal with?
Not so much tenants, but neighbours. It's probably too personal to go into those specific situations. But I have, as I alluded to earlier, had situations where tenants have decorated the property or want to move out early and things like that, where you've had to negotiate as to how you approach that. If you've tried to do all of that work that I've described earlier, you're going to avoid these situations. But inevitably, you will find situations where you may need to think on your feet. So say if you've got a 12-month tenancy agreement and for whatever reason that tenant wants to leave that property early, you could say, well, you've signed an agreement and you have to pay. Say they want to move into their own home and they've rented your property as an interim gap, and then they found their dream home and they've purchased that dream home, but they've still rented your property. You could say, oh, well, you've rented my property for 12 months. That means for your nine months in, you have to still pay my rent for the last 3 months. They might accept that, but move into their property, leaving your property vacant. Nobody really wants that as a landlord. You don't want a vacant property, whether you're receiving the rent on it or not, in my humble opinion. So that's where I would negotiate with that person and say, look, you'll continue to pay the rent until I find a replacement tenant. And as soon as I've got a replacement tenant, they will move in. I'll release you from the contract and you no longer need to pay the rent for the remaining part of the tenancy agreement. So it's not always about thinking, how do I maximize my profits? It's also about doing good business with ethical approaches, isn't it, to how you do that?
I fully agree. I think it's quite crucial to have good communication skills and to approach the matter in a way to find a win-win solution.
Yeah.
Because they're not going to accept being screwed over and they're going to retaliate, and then it gets worse.
Yeah.
So unless it gets there, then you're going to have legal costs and it's a nightmare from there on. So you're right. If we can do, if a landlord can do that effort in the beginning, then that will just save them later on 12 months or 18 months of just stress-free. So I fully agree with your method. I think it's a very smart one, which we implement as well. Everything has to be upfront. We don't want to have even a little bit of a gray area thinking, are we sure about this? Because we'd rather not. The properties we have, they're in amazing locations. So whenever it's empty, there are a lot of people who want to take it. So we want to handpick the right one. So you're right. So when it comes to the tenant perspective, it seems like you know exactly what to do to mitigate the risks. We started off very interestingly talking about Y property acquisitions, 18-year cycles or the other cycles, interest rates, the properties going up in price, down in price, how to have good return on investments, how to pick the right ones, getting in the right tenants. So it kind of covers everything in the property investor's journey, except the last bit on how one can mitigate the risks in terms of the asset itself, not the tenant now with the rental income, because the rents will help you pay your mortgage payments. But how do you protect yourself now as a landlord, maybe from property prices dipping or from anyone suing you or whatsoever? How do you have any principles that or philosophies that you live by in your investment journey?
I suppose you're talking about the exit strategy, really. This is, again, it's a bit of an individual thing. You need to think about why you're in property, what your personal situation is. So, say, for example, you've acquired a property portfolio over your lifetime and you're of the opinion that you want to leave that for your family. So one of your deciding factors is going to be, how do I pass this on to my next generation? If you've taken it from a business perspective and it's perhaps a bit more small time and you're looking at maybe those investments funding your retirement, that's where I'm talking about changing the structure of your portfolio. So you've moved away from having capital investment projects. You're moving away, like myself, from managing those lets yourself, and you want to restructure your portfolio so that you have more properties that have higher return from the rental perspective, and also from the perspective of management. You want to not do that anymore. You want to go and enjoy your retirement and travel around the world. So that's when you need to obviously develop a relationship with an individual, maybe like yourself, have somebody who does the rental management for you. So that's how I would shift that arrangement. So, these rent-to-rent schemes, other things of that nature, they're going to guarantee you a fixed amount of return on your portfolio. And you just need to make sure, obviously, again, you do your due diligence to make sure that you're now going to get what might be a lower return on your investment from a rental income perspective if you did manage it all yourself. But what you want at the end of your life is an easy life, in my opinion. So it's structuring it that way. Alternatively, you might want to just get out of the property game altogether. And I guess if you want to do that, you need to be planning ahead well in advance. And again, individuals need to take individual advice on that from tax professionals and investment professionals, because it will be very much dependent on your own circumstances. So personally, I've always planned that I will be exiting the property game altogether, and I'll sell my properties as I near retirement. And my plan has always been to avoid paying as much tax as possible. And to do that, I've always transferred potential profits into my SIP, my self-investment pension. Because you can make those transfers and then reduce your corporation tax bill, I essentially don't need to worry about the rental profits. So I just put it all into my SIP for later. And as I near retirement, and I think, well, I need to start selling off these assets, I'm then looking at how I'm going to do that towards the age of 58, when I can access my SIP. So maybe 3 years before I reach retirement, I will look at the properties and go, right, I'm going to sell this property. And I potentially have made quite a significant capital gain on that property. That capital gain is going to obviously be subject to corporation tax, and the rate of corporation tax at the moment, if it's over 50,000, I understand is going to be 25%. Well, if I look at that capital gain and think, well, as a director of that company, I could transfer at the moment, as it stands, £60,000 of that into my SIP, £60,000 into that to my other directors, SIP, my wife, then £120,000 already for that particular tax year has gone into our pension funds and hasn't been taxed at 25%.
So you don't have to pay capital gains tax if you were transferring it to your pension fund?
No, because you've reduced your tax bill beforehand by transferring into your pension, and pension contributions for a company are tax deductible. Then when you're drawing down from your pension when you're older, assuming it's at the basic rate rather than at the higher rate, you're paying then 20%. So these sorts of things, though, I'm not a tax expert in. I dabble and read and think, this makes sense to me. I check in with a tax advisor. But all of this, I need to caveat with, you need to obviously take professional tax advice, and everyone's individual circumstances are different. So it's just always be thinking, I suppose, about your exit strategy as well as what you're doing now, because the impact of tax on your investments can be huge, and getting a good tax advisor can save you not just thousands but tens of thousands of pounds. Really.
So from your research that you've done, is there a limit to how much one person can sell avoiding capital gains tax and putting everything into their pension fund?
Well, the cap on your pension contributions as it stands at the moment is £60,000 per year. So you would be looking to do that.
So it's limited to 60 grand. If you're going to sell something, make 2 million, 3 million from property.
Oh, wow. If you're talking those sorts of sums, then yes, it's a drop in the ocean as to how much you're actually avoiding paying your tax bill. But, if you're making £60,000 contributions to your SIP each and every year, and that is a small percentage of your overall profits, then it would make some sense to do that.
Is there any taxes you have to pay when you draw down from your pension fund?
Yeah, of course. You're still paying tax on your pension income as you would do with any pension.
Is that the same as your normal?
That would be 20%, I think, up to the basic rate, and then the normal income. Yeah.
So at the moment, I think it's over 40 grand. The first 12 grand is non-taxable.
That's right. And
till 40, I think it's about 19%, 20%. And then after 40, it's a higher tax bracket. So is it the same with
that would still apply when you're a pensioner, yeah.
Okay, so you're saving here, but you have to pay a little bit there as well, technically.
Of course, yeah. I mean, there's only two things in life that are guaranteed, aren't there? Death and taxes. So, you can't totally avoid it.
That's true. I suppose that is one very crucial thing that I factor in as well during looking at an investment. What is the exit strategy? Are we looking to sell it, or are we looking to refinance? And some people, as they look to build their portfolios, from my network of people that I know, they happen to have two different aspects to it. One of them wants to build a massive portfolio, as big as they can go, as much as they can leverage while still being as safe as possible, and not selling after. Just keep working on with the lenders and transfer that on to their children. I'm probably the greatest fan of Grant Cardone. I love his work as well. This guy he owns about $2.8 billion worth of real estate. That's like 10,000 apartments he owns. But what he's doing now, he's got children, I think age of 10, 15. He's training them from now, saying, if I was to pass, you don't sell real estate, you maintain and keep good tenants, you look after the property because that's going to bring in good tenants, and maintain your relationship with the lenders. Look after this, and this portfolio will feed you and your children and their children to come for the rest of their lives. So he has that as his exit strategy, training his kids to take over his portfolio. While you've got other people trying to build such a massive portfolio, thinking at the end of it, maybe if they've got 1,000 apartments, they're going to go to a pension fund and sell it to them at a 6% cap rate. So people have different aspects to it, but your right exit strategy is so important, because without one, you don't know how it's going to turn out at the end of it. So overall, Ross, it's been so great to have you on the show. I think I've learned a lot of you already, and I'm sure the audience would have found this podcast extremely valuable. So thank you very much for coming.
Thank you. Pleasure.